Morning, everyone. Welcome to this morning's edition of the MPC Markets Morning Call. It's 16th of March, 2026. Oil tops 100, and we have got oil rising a little bit this morning as well. Not as much as what you would expect overall, but maybe a few percent. And we're looking at a week where we're very stacked with central bank. Central bank announcements, etc. They're obviously going to be concerned around inflation with the rising oil price, and Iran essentially is not really, we're not seeing any major movement in terms of this being resolved anytime soon. It's entering its third week, and you've got WTI crude up 1.5% as it stands at the moment. It's about 5 to 10 o'clock, 5 to 10 in the morning, Sydney time. So and you've got Brent crude much higher than that. So yeah, Friday night we had some GDP numbers, and we essentially had the GDP numbers fairly wildly revised to the downside. And look, we've got some sources out of the Pentagon also saying that this Strait of Hormuz and this conflict's going to go on for at least sort of 4 to 6 weeks, and that from now basically, so that'd put it at 6 weeks. And then look, so overall, with weakening growth, with those GDP numbers being revised down, I think some weaker consumer numbers, and inflation being triggered not only by in the latest PPI numbers, etc., but by this oil move, that dreaded stagflation. And PCE, it was 3.1% year on year as well, which is well above that Fed target. And that'll be of sort of grave concerns in terms of there's only 20 basis points potentially of cuts now priced in at all in this market, whereas it was very clearly at 75 basis points earlier on in the year when we're at record highs. We've got 10-year notes in the US trading at 4.3, which is its highest level for quite some time. So you're just starting to see a bit of broad weakness, but it's the market map from Friday, but mainly in the bigger guys overall, Oracle, Broadcom, etc. There was a few positives here and there, but mainly in that sort of in those defensive sectors. But I suppose that would be just some broader index selling, I suppose, because it seems to be hitting those larger names. Overall, we've got the technicals in strong sell territory now across the board, except for the China A50. And look, that's not. It's not probably a proper reflection of a diversified index so much, but you concerningly got the Nasdaq, the Dow as a sell, and the S&P as a sell. The S&P and the Russell as neutral. The Aussie in strong sell territory for the index as well, and it was down a little bit on Friday. We probably will open up around about down 60, 70 odd points here. Gold and silver still drifting off, copper and platinum as well, as crude keeps rising. So that is usually the fairly normal in that first bit. Those the economic slowdown that inflation caused by higher oil prices brings to the economy is not good for those industrial or cyclical metals, and not even really for gold. It tends to come a little bit after. People still going, flocking back to the US dollar because it's just what you do in these scenarios. I think that's a massive trap overall, and I think it'd probably be one of your better situations to be, to be short in the US dollar or the US dollar index. The Aussie dollar getting hit here, considering we're lay down for a rate hike this week. It's probably not too bad at buying, but we are seen as a risk currency. But look, those commentaries often don't play out so well in in markets in the long run. So we had some positive news. We had some positive news from a few from TLX this morning and on the Aussie side as well. with an FTA progressing. So that should be, that bias tech sector's been relatively positive recently. But I just want to talk to you quickly about the where this S&P sits. So this very close to this 200-day moving average. I've just highlighted the sections where we've breached the 200-day moving average. The average drawdown from the first decisive daily close below the 200-day moving average has been about 16%. The average time spent below, and obviously this was the larger part. These stats go back to 2015, but this is the larger or the longer one. But it's 70 to 90 trading days, and but we do have a shock going on, and potential rapid policy response, but not in the right way. And then policy valuation scares, growth, Fed narrative shifts, which are all involved in this as well. And then inflation, and I don't think there'll be an aggressive tightening, cycle, but we will. There are elements of all these that basically are in this move overall, and if you look at it in the scheme of things, we've barely come off the highs, to be honest. So at this point in time, you've still got. It's not too late to be, to not necessarily be being short, but to be getting out. So we've still got private credit concerns. We've still got geopolitics going on. The Trump's looking like he's going to negotiate, so there may be a last little fake out, but the Iranians are doing a really good job at this point, because Trump keeps announcing deals and they keep coming on TV and immediately saying we haven't spoken to him, which the Chinese have generally ignored him. And then look, their major oil hub, I suppose, the island of Kaj. That's threatening to blow that up. Just is oil's price suicide for the US, I would imagine. There was some progress in terms of them letting through. Apparently, a couple of Indian ships have come through. Brave captain. Hats off to that guy. Whoever was the first one to bring it through. The Iranians have let some through, but they won't let through any US oil tankers. That could that largely eases about 2/3 of any of the pressure in oil, and will bring oil prices back a little bit. But basically this, any further this goes along, the worse it's going to get. And we've got to be very conscious of. We've obviously just got to be very conscious of how that's going to affect the equity market overall. So, but we do have some pretty good stats. On Mosaic around what sort of inflation effect that we would have, the longer we sort of drag on, and where it sort of tends to peak, etc. So you'll have to scan that QR code and get some of those exclusive content things. The actual content is free. You don't have to pay for anything on Mosaic unless you're getting the stock recommendations. There are some premium content features which get put out over, which get delayed by a few days, but you're still largely getting all of the content free. So we've got a really good thing in there on inflation and its effect with oil being up around these prices on global CPI for not for certain sectors of certain geographical places around the world, segments around the world and economies. So yeah, sign up now to Mosaic, and you can sort of get all this stuff in real time. It's probably a very good time to be having something like this, where basically you need to stay up to date if you want to actively manage your portfolio. But overall, we're in for another weekday. We've got 5 central banks this week. We've got a PPI number on Thursday in the US. And we've got employment data here on Thursday, as well as quadruple witching, which is the options expiry for all the indices, the stocks and the futures this Friday as well, which can see some pretty extreme volatility in the weeks coming after. So I would be definitely reviewing your portfolio, and then if you'd like us to review your portfolio, you can submit on the website I'll chuck that in the link to socials as well. And we can run our eyes over your portfolio just in case you're feeling a little bit lost out there. It's obligation free of charge. But have a great day, everyone, and we will speak again tomorrow. General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.